It's your favorite YouTuber, guys. DS Learn Finance, financially educating you guys to freedom. For the beginners, buy from beginner every Sunday at 3 p.m. The conventional way to buy a property via mortgage process is by you guys putting up typically 25% of the capital for the deposit and the stamp duty, and the mortgage provider giving you the remaining 75% of the property's purchase value. Now, with that mortgage that you take out, there are traditionally two ways to go about doing that. One, repayment. This is where you spread your payments over the months that the mortgage period provides. The main aim here is for you guys to pay back the amount that you've loaned. So typically speaking, it's that 75% plus the interest on top that the mortgage provider has added on for you guys to borrow that money in the first place. You pay off a fraction of this each and every month. But the second method, the interest only method, is where you pay each and every month only the interest added on top for buying that property. Now, at the end of that mortgage process, you're provided with three options to take. Option A, starting an interest only mortgage again and basically repeating the process. Option B, which is basically paying that principal amount. So, typically speaking, that 75% that you actually borrowed from them, plus no doubt interest on top. Otherwise, what's the point of them doing it? And oh yeah, you have to pay all of that back all in one go. Or option C, guys, which is starting a repayment process and paying off the property that way. Either route you take with the interest only method, you're going to eventually have to pay back the money that you loaned. It's just a case of how long do you want to prolong it for and how much interest you want to rack up while doing so. Looking at it all collectively, you can see that there are a handful amount of routes that you can take to purchase your property. So, which one's actually best, guys? Unfortunately here, one size doesn't actually fit all. It's very subjective. But what I'm going to do for you guys in this video is I'm going to give you the tools that I like to use for you guys to decide which one's the best route to take. If you guys like the sound of this, then let me know about it, people. Leave a like, subscribe to the channel with the notification bell on, share this video, and follow me on all of my social media platforms down below. You see, to truly answer this question, you guys need to be real with yourself. You need to ask yourself, what are you actually using this property for? What is your priority here? To me, it could be one of two things. One, control. Is what you need from this property just to be able to control it, manipulating it in such a way that makes more money for you in the long run? If so, then this might actually be better suited for interest-only mortgages. Or, one step further, option 2, which is ownership. Do you instead need to own the property to get what you want out of it? This might better suit taking out a repayment mortgage. Now, I know with some people, they're going to say that whichever route you take, you're going to own the property. Yes, this is correct. But this is also why I ask you guys which one is your main priority. Because with an interest only, your main priority isn't to own the property. Otherwise, why have you prolonged the payment towards the end of the process? Your main priority is to actually control the property. Some of the richest companies in the world do not own things outright. Amazon don't own their own stocks. Apple don't own their own music. But what they're able to do is control it and therefore make money from it. Now, I'm not saying you don't want to own it, but I'm saying what is your main priority there? There's a difference. Whilst in a capital repayment mortgage, your main aim is to actually own it. That's why you're paying it off month by month. This is thousands of pounds here that we're talking about. So you guys need to have a clear, concise idea of what you want to do with the property. Another parameter I also use to determine which one is the best for me to take for buying a property is by actually looking at the monthly payments. So generally speaking, an interest-only mortgage will have its monthly payments lower than a repayment mortgage, just because you're only paying the interest of the property. For example, if you wanted to buy, let's say, a 100k property and you wanted to cover 25% of that, 25k to cover the deposit and the stamp duty. So therefore, you've gone to the mortgage provider and been like, hey, can you give me the rest of this 75k to buy this property with? They said, cool, we can do that for you across a period of 25 years, but we're going to do 4% interest rate. for that. Each and every month, you have to pay £250 via the interest-only mortgage route. But that exact same deal via the repayment mortgage route instead will cost you £396, guys. This is a huge difference, guys. £146 difference between the interest-only mortgage to the repayment method. Deciding which route to take has a significant influence on your cash flow month to month. So make sure to think about that, people. My little tip for you guys is to actually run soft quote checks, soft quote, not hard checks, because that will affect your credit rating, soft quote checks to get an idea of what amount you're expecting to pay for that mortgage each and every month, and do it for both methods, guys. Then ask yourself some honest questions. Can you live with paying this mortgage each and every month? Or does it need to be lowered? Can you lower it by that much less? Is it worth lowering it? These are all valid questions that you guys need to find out the answer to. The numbers don't lie. However, just be wary, guys, of taking either route because they each come with their own cons. For a repayment mortgage, you can end up paying the property off each and every month. But then what's the point of doing that if you're going to sell it at the end of the mortgage period? What's the point? You could have increased your cash flow there. And in an interest-only mortgage, acquiring negative equity can really screw you over. This is where the property goes down in value at the end compared to what you actually bought it for. So technically speaking, for you guys to sell, you need to pay more money to do so. It's not a financially good route to take. But all of these pitfalls and more comes with the territory, guys. You need to ensure that you do your due diligence when it comes to these things. And I also have a bonus tip for you guys. Have a good financial advisor and mortgage broker in your corner that will be able to help you along the journey as well. I hope you guys enjoyed this video. I did. Before I leave, I want you guys to like this video, subscribe with the notification bell on, and share it too. It will help me a bunch. It's your favorite YouTuber, guys, DSL Finance, Financial Education. You guys to freedom for the beginners by Form Beginner every Sunday at 3 p.m. DS Learning Finance.
Whoa.